Right now, at this exact moment, your bank is sending a detailed report about your account to the federal government, and you never signed any form giving them permission to do that. You never received a notification, you never got an email, it just happened automatically and legally, and there is absolutely nothing you can do to stop it. And if certain things in your account look unusual to a government computer system that is scanning millions of accounts simultaneously, your life can get very complicated very fast without you ever knowing why or when it started. This is not a conspiracy theory. This is not something that might happen in the future. This is happening right now in 2026, and most Americans have no idea it is going on. Most people have a mental image of the IRS as a slow-moving government agency that sends paper letters and deals with tax returns once a year. That image is completely outdated. The IRS of 2026 is a technologically advanced surveillance operation with more funding, more staff, and more powerful tools than at any point in its entire history. In 2022, Congress passed the Inflation Reduction Act, which included $80 billion in new funding specifically for the IRS. A significant portion of that money went toward hiring new agents and building new technology infrastructure. The IRS now employs over 90,000 people, and their new generation of data analysis tools can cross-reference your bank transactions, your tax returns, your investment accounts, your payment app history, and your reported income simultaneously in real time. If anything does not line up perfectly, a flag gets raised automatically. No human being has to notice anything. The computer notices it for them. The legal foundation for all of this bank reporting goes back to a law called the Bank Secrecy Act, which was passed in 1970. This law requires every bank and financial institution operating in the United States to report specific types of account activity directly to the federal government through an agency called the Financial Crimes Enforcement Network, also known as FinCEN. Under this law, your bank must file a currency transaction report every single time you conduct a cash transaction of $10,000 or more. This report includes your name, your address, your social security number, the amount of the transaction, and the date. It goes directly to FinCEN, and from there it is accessible to the IRS, the FBI, the DEA, Homeland Security, and over 300 other federal and state agencies. Your bank does not ask your permission. Your bank does not inform you that the report has been filed. It simply happens as a routine legal obligation. But the $10,000 rule is not even the most dangerous part for ordinary people. The more dangerous rule is what happens when your transactions fall just under $10,000. Federal law also prohibits a practice called structuring, which is defined as deliberately breaking up transactions to avoid triggering the $10,000 reporting threshold. Here is why this is so dangerous for innocent people. If you deposit $8,000 one week and $9,000 the following week, your bank's automated monitoring system will flag that pattern as potential structuring behavior and file a suspicious activity report with FinCEN. The critical thing to understand is that structuring is illegal regardless of whether your money is completely legitimate. The law does not require the government to prove that your money came from illegal activity. They only have to prove that you were aware of the $10,000 threshold and deliberately structured your transactions to avoid it. People have had their entire bank accounts seized under civil asset forfeiture laws based on this rule alone, with no other criminal charges ever filed against them, and recovering that money required hiring lawyers and fighting in court for months or years. In 2020, the federal government launched a program that significantly expanded what banks are required to monitor and report. Under current Bank Secrecy Act regulations, banks are required to file a suspicious activity report anytime they observe a transaction or pattern of transactions that they believe might involve money laundering, tax evasion, fraud, or any other financial crime. The threshold for what counts as suspicious is deliberately left vague, which means banks err on the side of reporting rather than not reporting to avoid their own legal liability. According to data from FinCEN, financial institutions filed over 3 million suspicious activity reports in a single recent year. 3 million reports from banks that decided something about a customer's account looked unusual enough to flag. And remember, none of those 3 million people were notified that a report had been filed about them. The first time most people find out they have been flagged is when their account gets frozen or they receive a notice of investigation. The expansion of financial surveillance in 2026, goes far beyond traditional bank accounts. The American Rescue Plan Act of 2021 changed the reporting rules for third-party payment platforms in a way that affects tens of millions of Americans. Before this change, platforms like PayPal, Venmo, Cash App, Zelle, eBay, Etsy, Airbnb, and similar services were only required to send tax forms to users who received more than $20,000 and had more than 200 transactions in a single year. After the change, that threshold dropped to just $600 with no minimum number of transactions. This means that if you sell a used couch on Facebook Marketplace for $650, that platform is now required to send both you and the IRS a 1099-K tax form reporting that income. If you do not include that amount on your tax return and the IRS has a 1099-K on file showing you received it, their system will automatically detect the discrepancy and flag your return for review. The IRS received hundreds of millions of these forms in recent years, and their matching systems process every single one of them automatically. The Foreign Account Tax Compliance Act, known as FATCA, extended American financial surveillance beyond U.S. borders in a way that most people find genuinely shocking when they learn about it. FATCA was signed into law in 2010, and it requires foreign banks and financial institutions around the world to identify and report accounts held by American citizens directly to the IRS. Over 100 countries have signed intergovernmental agreements with the United States to implement FATCA compliance, which means that if you are an American citizen with a bank account in Canada, the United Kingdom, Germany, Singapore, or dozens of other countries, that foreign bank is reporting your account information to the American government. Americans are also required to file a report of foreign bank and financial accounts, known as an FBAR, with the Treasury Department if the total value of their foreign financial accounts exceeds $10,000 at any point during the year. The penalties for failing to file this report are severe. A non-willful violation can result in a penalty of $10,000 per account per year, and a willful violation can result in a penalty of the greater of $100,000 or 50% of the account balance per violation per year. One of the most significant developments in IRS surveillance capability in recent years has been the integration of artificial intelligence and machine learning into their audit and investigation selection process. The IRS has publicly acknowledged investing heavily in AI technology as part of their modernization efforts funded by the Inflation Reduction Act. These AI systems are trained on decades of tax return data, bank transaction records, and financial behavior patterns. They can identify correlations and anomalies that no human auditor would ever notice manually. For example, the system can compare your reported income against your lifestyle indicators, cross-reference your bank deposits against your reported wages, compare your business expense deductions against statistical averages for your industry, and flag anything that falls outside normal parameters. The IRS has stated publicly that they are using these tools to identify high-risk returns for audit selection. But independent tax professionals have noted that the same technology can and does flag ordinary middle-class Americans whose financial behavior deviates from expected patterns, even when everything they have done is completely legal. So what can you actually do to protect yourself, given that the surveillance system is real, it is legal, and it is not going away? The first and most important step is to make sure your financial records are completely clean and documented. Every dollar that comes into your bank account should have a clear paper trail explaining where it came from. If you sell something online, keep the receipt. If someone repays you a loan, keep a record of the original loan. If you receive a large cash gift, understand the gift tax rules and document accordingly. The IRS gift tax exclusion in 2026 allows individuals to give up to $18,000 per recipient per year without any gift tax consequences and without any reporting requirement. Amounts above that require the giver to file a gift tax return, though actual gift tax is rarely owed due to the lifetime exemption of over $13 million. Knowing these rules and following them correctly eliminates the risk of legitimate money transfers being misinterpreted as unreported income. The second practical step is to understand and use the financial accounts and structures that are specifically designed to be tax advantaged and legally protected. A Roth IRA allows your money to grow completely tax-free, and qualified withdrawals in retirement are not reported as income, meaning they do not create discrepancies between your bank deposits and your reported income. A health savings account allows you to contribute pre-tax money, invest it, and withdraw it tax-free for qualified medical expenses. A 529 college savings plan allows money to grow tax-free when used for qualified education expenses. These accounts are not loopholes or tricks. They are legal structures that Congress specifically created and that the IRS fully recognizes. Using them correctly is not avoiding taxes. It is following the tax code exactly as it was written and intended. The people who end up in trouble with the IRS are almost never the people who understood the rules and followed them carefully. They are almost always the people who did not know the rules existed. The final thing every person needs to understand is that the relationship between Americans and their financial institutions has been permanently and fundamentally changed by the technology and legislation of the past decade. Your bank is not just a place that holds your money. It is a legally deputized reporting agent for the federal government. Every transaction you make is monitored, recorded, and potentially reported. This is the reality of the financial system in 2026, and it is not going to change. What can change is how prepared and informed you are about how that system works. Keep clean records. Understand the reporting thresholds. Use tax-advantaged accounts. Report all your income accurately, including income from payment apps and online platforms. And if you ever receive any kind of notice or inquiry from the IRS, do not ignore it and do not try to handle it alone. Contact a qualified tax professional immediately, because in the current environment, the cost of not responding correctly and quickly can be far greater than the cost of getting proper professional help from the very beginning. The most important thing to understand about the current IRS enforcement environment is that the agency has fundamentally shifted its focus in 2026 from reactive to proactive investigation. In the past, the IRS would typically wait for a red flag to appear on a tax return before opening any kind of inquiry. They would review returns, spot obvious problems, and then begin an audit process that was slow, methodical, and heavily documented. That model no longer describes how the IRS operates today. The modern IRS uses predictive analytics to identify taxpayers who are likely to have compliance issues before any return is even filed. They are looking at your bank account activity throughout the entire year, not just at the end of it. They are cross-referencing data from multiple sources simultaneously, including your employer payroll records, your investment account statements, your real estate transactions, your payment app activity, and your social media presence in some cases, to build a comprehensive financial profile of who you are and what your money should look like. If the picture that emerges from all that data does not match what you eventually report on your tax return, the discrepancy is flagged automatically before a human agent ever looks at your file. One area where thousands of ordinary Americans are getting into serious trouble in 2026 without any awareness that they are doing anything wrong involves peer-to-peer payment apps and the new reporting rules that surround them. Venmo alone has over 90 million active users in the United States. Cash App has over 50 million. PayPal has been around for decades and has hundreds of millions of accounts globally. These platforms are woven into the daily financial lives of ordinary Americans in a way that was simply not true 10 years ago. People use them to split restaurant bills, pay their share of rent, reimburse friends for concert tickets, pay babysitters and house cleaners, sell handmade goods, and conduct dozens of other small financial transactions every week. What most of those people do not realize is that since the threshold for 1099K reporting dropped to $600, every one of these platforms is now required to report their payment activity to the IRS. And the platforms themselves are not sophisticated enough to distinguish between a taxable business transaction and a personal reimbursement. If your roommate sends you $650 through Venmo for their share of the monthly rent, that platform may generate a 1099K form reporting that as income. And if you do not address it correctly on your tax return, the IRS system will see unreported income and flag your account automatically. The cryptocurrency landscape has added an entirely new and extraordinarily complex layer to the IRS surveillance situation that most Americans who own any digital assets need to understand urgently. The IRS has been clear since 2014 that cryptocurrency is treated as property for tax purposes, meaning every single time you sell, trade, or exchange cryptocurrency, you have a taxable event that must be reported on your tax return. But in 2026, the enforcement of these rules has reached a new level of intensity.
The Infrastructure Investment and Jobs Act, passed in 2021, included provisions that require cryptocurrency exchanges and brokers to issue 1099 forms to customers reporting their transaction activity, similar to how stockbrokers report stock sales. This means that if you bought Bitcoin on Coinbase 3 years ago and sold it last year for a profit, Coinbase sent a form to both you and the IRS reporting that sale. If you did not report the gain on your tax return, the IRS system already knows about the discrepancy. Furthermore, the IRS has been using blockchain analytics companies to trace cryptocurrency transactions even when they occur on decentralized platforms that do not have traditional customer records. The idea that cryptocurrency transactions are private or untraceable is dangerously outdated thinking that has already cost many people significant money in back taxes, penalties, and interest. Small business owners and self-employed individuals face a particularly intense level of financial scrutiny in 2026, and many of them are completely unprepared for the level of documentation that is now expected of them. When you are self-employed, every dollar you earn is income that you are responsible for reporting, including cash payments, barter arrangements, payments received in cryptocurrency, and income from any source, regardless of whether you receive a formal tax document for it. The IRS knows what self-employed people in specific industries typically earn based on decades of data, and their AI systems flag returns where the reported income seems unusually low relative to what comparable businesses in the same area and industry typically report. Business expense deductions are another major area of scrutiny. The IRS has detailed statistical data on what percentage of their gross income businesses in each industry typically claim as expenses. If your expense deductions are significantly higher than the statistical average for your business type, that deviation alone can trigger enhanced review. This does not mean you should not claim legitimate deductions. It means you need to keep meticulous records with receipts and documentation for every single deduction you claim, because in an audit, the burden of proof is on you, not on the IRS. Real estate transactions have always attracted significant IRS attention, and in 2026, that attention has intensified considerably with new reporting requirements and enforcement priorities. When you sell a primary residence, you can exclude up to $250,000 of capital gains from your taxable income if you are single, or up to $500,000 if you are married filing jointly, provided you have lived in the home as your primary residence for at least 2 of the 5 years preceding the sale. However, this exclusion must be properly documented and reported on your tax return, even if no tax is ultimately owed. Real estate investors who buy and sell properties as a business face an even more complex tax landscape with rules around depreciation recapture, like-kind exchanges under Section 1031 of the tax code, passive activity loss limitations, and net investment income tax. The IRS receives information returns from title companies and closing agents whenever a real estate transaction occurs, which means they know about every property sale regardless of whether the seller properly reports it. Failure to report real estate gains correctly is one of the most common triggers for IRS audits of middle and upper middle class taxpayers. The estate and inheritance tax rules represent another area where many families are unknowingly creating serious IRS problems for themselves in 2026. When someone passes away, their estate may be subject to federal estate tax if its total value exceeds the current estate tax exemption, which in 2026 is approximately $13 million per individual under existing law. However, there is significant uncertainty around this number because provisions of the Tax Cuts and Jobs Act of 2017 that doubled the exemption amount are scheduled to sunset at the end of 2025, which could reduce the exemption back to approximately $7 million adjusted for inflation. This potential change affects far more families than most people realize, particularly those with significant real estate holdings, business interests, or investment portfolios. Even families whose estates fall well below the taxable threshold can create IRS problems through improper handling of inherited assets, failure to file required estate tax returns, even when no tax is owed, or incorrect reporting of the stepped-up cost basis that inherited assets receive under current law. Working with an estate planning attorney and a qualified tax professional well before these issues arise is essential for families with any significant assets. The IRS audit process itself is something that most Americans have wildly inaccurate mental images of,
and understanding what it actually involves is important for anyone who wants to be prepared. There are several different types of IRS audits with very different levels of intensity. The most common by far is the correspondence audit, which is simply a letter from the IRS asking you to verify a specific item on your return by mailing in supporting documentation. These are typically resolved relatively quickly if you have good records. More serious is the office audit, where you are asked to come into an IRS office and meet with an examiner to discuss specific issues on your return. The most intensive is the field audit, where an IRS agent comes to your home or place of business to conduct a comprehensive examination of your financial records. Field audits are typically reserved for complex returns with significant amounts of money at stake, or where the IRS suspects serious compliance problems. Regardless of which type of audit you face, the single most important thing you can do is respond promptly, provide exactly what is requested and nothing more, and work with a qualified tax professional such as a CPA, enrolled agent, or tax attorney who has experience handling IRS examinations. Understanding your legal rights when dealing with the IRS is something that most Americans are completely unaware of, and this lack of awareness puts them at a serious disadvantage. The Taxpayer Bill of Rights, which was formally adopted by the IRS in 2014 and codified into law in 2015, guarantees taxpayers 10 fundamental rights in their dealings with the agency. These include the right to be informed about IRS decisions and the reasoning behind them, the right to quality service and prompt responses, the right to pay only the correct amount of tax and nothing more, the right to challenge IRS positions and be heard, the right to appeal IRS decisions both within the agency and in the federal courts, the right to finality so that the IRS cannot keep an audit open indefinitely, the right to privacy so that IRS inquiries are no more intrusive than necessary, the right to confidentiality so that your information is not shared improperly, the right to retain representation by a qualified tax professional, and the right to a fair and just tax system. Knowing these rights and asserting them calmly and clearly when dealing with the IRS can make a significant difference in the outcome of any tax dispute. The Taxpayer Advocate Service is a critically important but massively underutilized resource that every American should know about. This is an independent organization within the IRS whose entire purpose is to help taxpayers who are experiencing significant hardship as a result of IRS actions or who are unable to resolve their tax problems through normal IRS channels. The Taxpayer Advocate Service is free to use and is available to any taxpayer regardless of income level. They can intervene when the IRS has made an error, when normal IRS processes are not working, when an IRS action is creating immediate significant hardship, such as a bank levy or wage garnishment that prevents you from paying basic living expenses, or when you have been trying to resolve a problem with the IRS for an extended period without success. Each state has at least one local taxpayer advocate office, and the national office is located in Washington, D.C. If you ever find yourself in a situation where the IRS has taken action against your account that you believe is wrong or that is causing you serious financial hardship, contacting the Taxpayer Advocate Service is one of the most powerful steps you can take, and most people have never heard that this resource even exists. The bottom line that ties all of this together is a simple but profound truth about the financial world of 2026. The era of financial anonymity for ordinary Americans is completely and permanently over. Every dollar you earn, every dollar you spend, every dollar you save, every dollar you invest, and every dollar you transfer is being tracked, recorded, and potentially reported to government agencies that have more sophisticated tools than ever before to analyze that data and identify anything that looks out of place. This is not going to change. If anything, it is going to intensify further in the coming years as technology continues to advance and as government agencies continue to expand their data collection and analysis capabilities. The only rational response to this reality is not fear and not paranoia, but rather education, preparation, and intentional financial behavior. Know the rules that apply to your situation. Keep clean and complete records of all your financial activity. Report your income accurately and completely. Use the legal, tax-advantaged structures that exist specifically to help you keep more of what you earn. And build relationships with qualified financial and tax professionals who can help you navigate a system that is more complex and more consequential than it has ever been before. The people who will thrive financially in this environment are not the ones who try to hide from the system. They are the ones who understand it well enough to work within it intelligently and confidently.